Welcome to the Deep Dive. We're here to cut through the noise of earnings season, pull out the key takeaways, and save you, well, hours of transcript reading. Today, we're digging into the AAON second quarter 2025 earnings call. That dropped back on August 11th.
And anyone watching the market that day certainly felt it, a really harsh reaction.
Yeah.
This call was, unfortunately, a classic case. You know, a company with great growth potential hitting just a massive operational snag.
Totally.
The results got completely buried under these, frankly, catastrophic execution failures. It forced management to make a pretty deep cut to their full-year guidance.
Exactly. So our goal here is to summarize those let's call them disappointing results, and really unpack what went wrong, the root cause.
It's this ARP story, isn't it?
It really is. We're calling it the irony trade. Amazing demand running headfirst into, well, internal chaos, all centered around their new ERP system rollout.
Okay, so let's hit the numbers first, the stuff that made everyone nervous. Revenue landed at $311.6 million.
Which, okay, on the surface, only down 0.6% year over year. Modest.
Right, but it missed the consensus by over 6%, 6.2% to be exact. But the real pain, that was all on the profit side.
Yeah, and the profitability, just brutal. Where did it fall apart most?
Well, non-GAAP EPS came in at just 22 cents.
Ouch.
Yeah, that's down a sharp 64.5% from last year, and it missed what analysts were expecting by almost 30%.
Wow.
And look at the gross margin, it just collapsed, really. Down to 26.6%.
So that's what, 950 basis points?
950 basis points year over year.
For anyone not living in basis points, that's 9.5% of margin. Just gone.
Right.
Compared to last year. That is a huge hit.
It's massive. And, you know, management didn't really mince words about why. The CEO basically said results, quote, fell short, driven by poor operational execution, mainly associated with the implementation of our new ERP system at Longview.
So they pointed right at it, the Longview ERP.
They knew exactly where the blame lay. No ambiguity there.
Okay, but before we fully descend to that operational mess, let's just touch on the one bright spot, the thing keeping the recovery story alive, maybe.
Demand. Absolutely. You have to talk about the backlog. Adjusted backlog is still rock solid, $1.12 billion.
Billion. And that's up how much?
Up a huge 71.9% year over year. So this is, you know, revenue visibility for quite a while. And critically, it's where future margin recovery has to come from.
Okay, let's unpack the chaos then. The ERP Enterprise Resource Planning System, it went live April 1st at the Longview facility.
Right.
Now, for listeners maybe not deep in manufacturing IT, what exactly is an ERP system? Why does it going wrong cause this kind of meltdown?
Yeah, think of it like the company's central nervous system, digitally anyway. It manages everything, ordering parts, inventory, planning what gets made when, shipping, billing. The whole works.
That's how it breaks.
The company basically flies blind. Materials don't move right. Production gets jammed up. Things just stop working efficiently.
And the failure at Longview specifically wasn't just about that one plant, was it? It created a bigger bottleneck.
That's the key. Longview isn't just an assembly site. It makes critical components, especially coils, for the much larger Tulsa operation. So the core problem was, well, twofold. First, the new system just crushed coil production efficiency at Longview. This hit both the AAON branded gear made there and the specific coils themselves.
And second,
and this is a really critical part, that coil shortage immediately starved the Tulsa plant. Tulsa relies on Longview for most of its coils.
So Longview sneezes, Tulsa catches a major cold.
Pretty much. Tulsa's main assembly line basically lost its fuel source.
And then the story gets even worse, almost comically bad timing with their backup plan, right?
Unbelievable, yeah. Their contingency plan, using external suppliers for coils, just evaporated.
Why?
Management said their two main external coil suppliers were, at the exact same time, doing their own ERP upgrade.
You're kidding! Seriously?
Seriously. It's just an incredible coincidence of bad luck. It completely wiped out their backup, so the internal mess became a full-blown crisis.
Wow. Okay, so that double whammy, internal failure plus external failure, you can actually put a number on the damage, can't you?
They did. They estimated the whole ERP situation and the supply chain issues knocked about $35 million off Q2 sales.
And the profit hit.
Even worse, roughly $20 million off the gross profit line.
20 million. Just from this.
And if you drill down into that specific coil segment, the AAON coil products, I mean, it's painful. Gross margin there contracted by 1,990 basis points.
Almost 20 percentage points of margin. Gone.
Just evaporated because of the systems change. Yeah.
And we should probably remember, too, this wasn't just lost production efficiency, right? There were other costs hitting the books.
Definitely. SG&A, your selling, general, and admin costs, they were up to higher depreciation, amortization, and of course, big bills for tech consultants trying to fix this ERP mess.
Right, the cleanup crew.
Plus, don't forget the new Memphis facility startup. That added another $3 million in costs this quarter, with almost no sales yet to offset it.
So it all piles on. The full cost of this ERP failure really hitting the P&L from multiple angles.
But despite all this, management is really trying to emphasize sequential improvement. They're pointing to signs things are getting better.
What are they highlighting?
The main data point was production efficiency. It apparently hit rock bottom in April. Longview's AAON branded equipment production was down 50% then.
Oh, 50%. Okay.
But they said by the end of July, it had improved. Still down, but only down 37% compared to the average rate in the first 9 months of last year.
So trending better, slowly.
And they made a point of saying July was actually their strongest production month all year so far.
Okay, so that's the narrative they're pushing. Look, April was the pit. We're climbing out. The second half of 25 is the recovery.
That's the story. Whether you buy it, well, that's the question. But it's hard to ignore the demand side here. Even with this operational disaster, the underlying business drivers look strong.
Right, let's shift gears to that, because this is where things get, frankly, quite interesting despite the Q2 execution. The specialized solution side, BASX, that's the big growth engine now, isn't it?
Absolutely crushing it. BASX branded sales jumped 90% in Q2. 90.
Wow. And that's mostly data centers.
Almost entirely driven by data center momentum. The numbers are just explosive. Data center specific sales were up 127% in Q2 alone.
Okay.
And year to date, up 269%.
269%. And this isn't just basic stuff, right? They're moving into more complex cooling.
Exactly. This is high value thermal management. Their liquid cooling solutions, for example, made up about 40% of the total BSX data center sales so far this year.
That shows real traction in the advanced stuff.
And they flagged a big win too. A strategic partnership and a major order from Applied Digital for thermal management in Applied Digital's AI factory.
That's a great proof point. Winning complex, high-margin, next-gen deals, even while the core business struggles with execution.
And even that core AAON brand, it showed some resilience. We know the overall market for non-residential construction has been kind of soft. Industry volumes down maybe 10% or so.
Right.
But AAON branded bookings actually grew double digits year over year in Q2.
So they're taking share, even in a down market.
Looks like it. And their focus on national accounts seems to be paying off big time.
How so?
Orders from those national accounts grew 163% year over year in Q2.
Whoa.
Yeah. And they now make up 35% of total AAON branded orders. That's up from just 20% a year ago.
Okay, that's significant penetration.
Plus, their Alpha Class heat pump bookings surged about 61%. So there's definitely strong underlying demand across the board.
And all that strength feeds into that huge backlog we mentioned earlier.
Right, which is the whole mechanism for the second half margin recovery story.
Okay, this is key. Explain why that backlog is supposed to fix the margins.
Okay, so the stuff they actually produced and shipped in Q2, that was mostly orders taken before they put through some crucial price increases.
Older, lower-priced orders.
Exactly, to deal with inflation and tariffs. Management confirmed that pretty much everything left in that $1.12 billion backlog has two important things baked in.
Which are?
First, a 3% price increase they implemented back on January 1st. And second, a 6% tariff surcharge they added in March.
So hold on, we're talking about a built-in, 9% pricing tailwind sitting in the backlog just waiting.
Essentially, yes, 9% of embedded pricing power that just hasn't hit the income statement yet because of the production delays.
Gotcha.
So as they hopefully clear that backlog in the second half of 25, that favorable price versus cost dynamic should finally start showing up in the results meaningfully.
Okay. And that context helps explain the big guidance reset for the full year.
Yeah.
They basically had to bake in this ERP disruption.
Right. They took down the full year sales growth forecast. It was mid to high teens. Now it's just low teens.
And the margin target, that took a big hit too.
Huge cut. From around 33% gross margin down to 28-29%.
Ouch. Okay.
SG&A guidance also went up as a percentage of sales to 16.5-17.0%. CapEx, though, they kept steady at $220 million.
But okay, if you look at that new lowered guidance for the full year, and they did in the first half, doesn't that imply a massive ramp up in the second half? Especially Q4.
That's exactly right. It implies a spectacular sequential acceleration. The implied Q4 forecast suggests year-over-year revenue growth somewhere in the high 20s.
High 20s revenue growth.
Yeah.
After being slightly down in Q2.
And maybe even more importantly, it implies gross margins snapping back to the low 30s range.
Low 30s.
Yeah.
From 26.6% in Q2.
Yeah.
It is a heroic bounce back they're forecasting.
It is ambitious, let's call it that. They are basically betting the farm that the operational improvements they saw starting in July not only stick, but actually get much better really fast.
So they can finally get that 9% pricing power through the system and onto the P&L.
That's the bet. That production stabilizes enough to let the good pricing flow through and essentially save the year from a margin perspective.
But wait a minute. Are they really saying they've fixed or are fixing a catastrophic company-wide IT failure, a complex supply chain mess, and massive internal production snags, all within basically 6 months, April to, say, October? Is that even plausible?
It requires, let's say, near flawless execution from this point forward.
Yeah, no kidding.
Management's line is that they learned a lot from Longview. They even sort of framed Longview as the planned stress test before they roll out the ERP at the bigger Memphis and Tulsa sites.
Convenient framing, maybe?
Perhaps. But they're selling the story. The worst is done, lessons learned, and 2026 will see double-digit growth again, margins improving, heading back towards that long-term goal of 32% to 35%.
Okay.
But yes, you're right to be skeptical. That implied Q4 recovery hinges completely on operations actually delivering stable, efficient production. It's a big if.
All right. Which brings us nicely to the part of the deep dive where we connect the dots, maybe throw out some thought experiments. This is our standard disclaimer. But let's talk tactics segment, not financial advice, of course.
Of course. And the starting point is clear. The execution risk is sky high. The market saw this ERP disaster, priced in ongoing problems, lots of negative sentiment, lots of selling.
Understandably. Yeah. But does that create an opportunity? This sets up a potentially compelling, though definitely aggressive trade idea. It's based purely on that margin recovery thesis.
The market's pricing in continued pain.
Right. But the company's own Q4 guidance requires that gross margin snaps back to the low 30s, driven entirely by that 9% pricing power finally hitting once production stabilizes.
And the conviction, if you have any, comes from the backlog. You know the price is in there, it's fixed. The only real variable left is production. Can they make this stuff?
Exactly. So the plausible but outrageous trade idea, maybe a short-term options play, betting specifically on a significant margin beat relative to current depressed expectations for Q4 2025.
You're targeting that gap between the implied low 30s margin in the guide and maybe their historical potential in the mid 30s if things really click.
The outrageous part is betting that management actually can fix this massive, complex IT and operational failure on their predicted timeline. It's a huge leap of faith.
It is.
But the visibility and the backlog pricing, combined with that undeniably strong demand, especially from BASX and the alpha-class heat pumps, that provides the, let's say, rational underpinning for the bet.
It all comes down to execution. If production is stable, the favorable price-cost dynamics should finally flow through to the bottom line. It's purely an execution game now, isn't it? The July data points, the backlog pricing, that's the roadmap they've laid out. So let's try to wrap this up. The core conflict in this deep dive. You had fantastic demand signals, AI momentum, BASX killing it, national accounts surging, huge backlog.
Just spectacular underlying demand.
Completely sideswiped by, well, terrible internal execution, the ERP rollout disaster. Textbook case. So the key question for you, the listener, the investor, is really, do you believe that implied Q4 recovery is real? That high 20s revenue growth, that bounce back to low 30s margin? Is it achievable?
Especially given how badly the ERP problems rippled through the whole system earlier in the year.
Exactly. This story is now 100% about whether management can deliver the operational stability needed to actually capture the margin that's already sitting there locked in their order book.
The things to watch: Q3 results, Q4 results. Do they validate this margin rebound story? Or do they prove the market's initial fears were right all along?
That's the ball game.
Okay. Remember, this was just for discussion, definitely not financial advice. Thanks for diving deep with us today.